I think we can begin. Yeah, it's working. Yeah, I think so. Well, welcome everybody. Good afternoon. Welcome to Bruegel. Thanks for joining us for the next hour and a half or so. We will be discussing EU and China clean tech and all of that entails. I think many in the room here have worked on that for months and years now, and there's lots we can unpack. So I'm looking forward to it a lot. Without much further ado, I will introduce our panelists, and then we kick off the discussion. We have Alicia Garcia Herrero, who's a senior fellow at Bruegel, and he was also joined by Haoxin Mu online, whose name I probably pronounced incorrectly, but I hope well. And they'll give a kickoff presentation for some new Bruegel work on this topic. We then will turn to Joseph Delatte, who heads the Energy and Climate Studies in the Institut Montaigne in Paris, in France. He will also give a presentation of some new work which he's been working on. And finally, we will then get comments from Barbara Glowacka, who now is in the Secretary General of the European Commission and the Economic Security team, and has worked on these issues now for at least the last few years in a few different positions. One thing for our online audience, who I also welcome, is that when we get to it, or already as they're talking, you can put questions on Slido. You use the hashtag EU-China-Green, and if you put questions online, I'll see them on this iPad in front of me, and I'll try and post some of them to our panelists later on. Those of you in the room, feel free to put on Slido, but of course, later on, just raise your hand and I'll give you the floor to ask questions. I will hand over to Alicia and Haoxin for 10-15 minutes. Who'll give an opening presentation. Thanks.
Thank you so much for the intro. It's great to be here with Haoxin. Haoxin is in Hong Kong. Well, we already had a publication for Bruegel on this topic, which was mostly on green tech versus green infra in China. And this is kind of a follow-up, basically to conclude that China needs something that Europe has been talking about for a long time, which is green finance. So that's kind of the next step of our work. If the slides can be uploaded, I'll start right away. Yeah. So I think, are they there? No, maybe not. I don't know. So maybe I'll start because, for the benefit of time. Oh gosh, this is not the Bruegel version. Never mind. You know, these are surprises you get when, but it's fine. I think most of the stuff should be there. It's not the right version, so it won't look very pretty, but you will get the pretty version uploaded somewhere, I hope. So, so this is a story. So it's about China's supply-driven green transition, very different from Europe, and why that supply-driven transition needs more funding. That's not moving. Okay, so maybe I have to do it from my head. Okay, sorry. Let's start. So we are talking about China now, not only because I like to talk about China, it's because China is essential for this issue, both on the problem and the solution. The problem is China is the largest emitter, but China is also the largest producer of green energy, green tech. Not green energy, green tech, because we could talk about actual generation of energy being an issue for China. But I think that the key point here is that, China is big for both, and China is also big for others to navigate that transition because it's the largest exporter of green tech. So for all of those reasons, wow, this is kind of beyond what didn't do anything. Okay, they're changing to the beautiful one, so that's great. Wonderful. So again, let me move to the motivations for this paper. So when we talk about China's green transition, we tend to think about targets, net zero, 2060. But there's two major reasons. I'm not saying China doesn't want to, attain those targets and as wonderfully as we do. No, that's not my comment. But I do want to say China has two major objectives beyond that one. And one is quite understandable, given how the world is shaping, which is self-reliance. We hear about self-reliance everywhere. Can you imagine not thinking about self-reliance in energy? Of course, it's essential. And the second one is, of course, industrial competitiveness, the cost of energy. So without these two things, we cannot understand what China is doing. That's why it's supply-driven, and we'll hear more from Joseph later. So when you think about self-sufficiency, some people think, oh, China is probably at the highest level in self-sufficiency in energy ever. No way. It's at the lowest level. Because before it was all domestic coal. And now, of course, because the Chinese economy is much bigger, it needs more energy. And that energy doesn't come from coal anymore. Partially, of course, coal is still very important. But the share of fossil fuels that China needs to import is humongous, and therefore China needs green transition as we speak. So that's, I think, very important to realize that there's this massive objective to reduce that lack of self-reliance back to where it was, even 90 or 95%, and that implies a lot of renewables, but also, of course, nuclear, hydropower, you name it. And why solar and wind in particular has been, the largest kind of thinking. Of course, hydro also. Hydro, we have this massive project now in Tibet, $160 billion to start. So, it's not only, we hear about solar and panel, but that's not the only thing that is happening in China. But because you can see there, the cost of energy by power source, hydro, lowest, followed by solar and wind. So that's what they are doing, yeah? And probably nuclear looks high compared to what it might look in the future, yes? So there's a question of time that bar will go down. I think I'm going to pass the floor to Haoxin directly, and I'll come back with a conclusion. So, Haoxin, the floor is yours. And you're muted still. I don't know if you can hear me. Haoxin, can you hear me? Okay. Doesn't look good. Yes.
Hi, Alicia.
Yes.
Hi, everyone. Sorry, I realized there might be a lag in time. So, Alicia, I think we are on page 6. So I will just start without further ado. So, as you just mentioned, driven by the China's policy targets to cater its need for energy independence and also the cost advantage because of the fiscal support, renewable capacity has surged during the past decade to unprecedented level that this world has seen, and we do think that will continue in the longer term because China has set targets for non-fossil fuels and share in total consumption. And to achieve those targets, China needs to double the renewable power generation by 2030 and by 5 times by 2060. So basically, China has a secular demand to ramp up renewable power generation over the longer run. And if you turn to next page, page 7, but it's not all that rosy because Chinese green tech companies, especially the solar PV ones, they are paying the price for their over-optimism after 2020 when China announced the dual carbon targets. And their over-optimistic forecast of the global demand for renewable energy has driven them to ramp up their capex and expand the production aggressively. But when the trend reversed in 2023, after people realized that the renewable power is being installed slower than expected, as opposed to 2022, when the world, especially Europe, faced trying to decouple with Russia and imported much more renewables, and things are getting worse. And that's when we see the divergence between China's export value and volume of solar panels. Basically, Chinese companies, they are trading the price for orders to keep them survive. And beyond the price war, they are also turning from abroad to the domestic market, as we see China's installation is ramping up so fast in 2023 and 2024 before they weakened in 2020 in the second half of 25. And moving to the next page, we see these two strategies by the Chinese companies didn't work out because the prices are have been truncated by half or even more across the whole supply chain. And we see the Chinese solar companies experiencing losses in the past 2 years, and their operational cash flow has facing humongous pressure, and they had to increase their external funding to keep them alive, as we see in the right chart. Still, the free cash flow is will be far negative without these fundings. And if we move to the next page, their pressure is not over yet because the new installation is set to slow further for China for simply two reasons. The front-loaded installation in 2023, in 23 and 24 made it so easy to achieve the policy targets, even the new one that President Xi Jinping just announced in last September. China can easily achieve them. So there's no pressure for the state-owned enterprises to keep investing in renewable. So that's for one. And on the other hand, China has removed the last layer of subsidy, namely the feed-in tariff for renewable power. And we see take Guangdong province, which is the China's largest province in economic size. The removal of feed-in tariff has hampered the ROI, return of investment, for renewable projects, and that will weigh down the new installation as well. And moving to the next page, page 10, we should be on page 10. Sorry for this extra explanation, but that doesn't mean China's energy transition is grinding to a halt. At least China is not playing so, because there is a serious problem it needs to fix now, which is the divergence between renewable capacity and renewable power generation. And we see, although we know renewable power, they are naturally unstable, and they are not utilized as much as the fossil fuels because of for the natural reasons. There we do observe a widening gap, especially for solar PV, between the capacity and generation in recent years. And that is mostly related to China's lagging in investment in the power grid, as we see in the right chart. And this gap has widened to 600 billion RMB as of 2023, but in 2025 is narrowing as State Grid is ramping up the capex. And next page, please. And it's doing more. The State Grid Corporation has announced that it's going to increase the capex from 2.8 trillion from the past 5 year plan to 4 trillion in over the next 5 years. And on average, that's going to boost China's GDP by 0.2 percentage points per year. And this will continue to fuel China's energy transition, despite the waning profitability, because it means China is not delaying the transition, but to achieve that, it just needs more funding. And if it is not coming from the internal, which namely retained earnings and operational income, it's going to look outside. And next page. And so far, and today, China's energy transition finance is dominated by bank loans. And that's reasonable because China has the world's largest banking industry, but that has been tightening due to the banks increasingly worry about the asset quality, as we have seen from the renewable companies' deteriorating financial health. And we can see that the green loan growth from the 6 largest state-owned banks has been truncated from 40% in 23 to 20% in 24 and 10% as of the first half of 2025. So if banks cannot do as much as it did to fund the energy transition, where else can we look at? And next page, we see that bond finance is actually being the increasingly popular option for the power sector. And the sector's bond issuance in China's onshore market has increased by tenfold in the past 3 years. And this is not only for onshore, but also moving increasingly for offshore, as we see the state administration of foreign exchange has initiated a pilot program this year to encourage resident enterprises to increase their cross-border green finance to continue their energy transition. And we are seeing the overseas bond issuance also surging since 2024. So the takeaway is China is not going to halt or pause or even stop its energy transition, but it's going to keep pushing on that, and to do that, China needs funding, and that if that's not coming from the banking sector, it's gonna it will be the it will be to the wider extent the ESG investors from both domestic and the world. And with everything here, I pass the floor to Alicia for conclusion. Thanks.
I think housing has already kind of concluded. Maybe only thing to add is, consequences for us all, or at least the Europeans in the room. I think we need to realize that, again, self-reliance, competitiveness, but now to achieve that, a lot hinges on the financing, because China can no longer rely on all of these massive profits from the rest of the world. It needs more. Now, more from where? Could be domestic savings. But at the same time, China has a lot to keep afloat so it is quite clear that China is looking overseas for at least part of this green financing. And therefore, now, I'm not saying there's not enough savings in the world to accommodate China's green transition, and that might hurt us. I wouldn't put it so negatively. But I think this big actor is coming to the forefront. We had not seen it for a long time in overseas market. We knew that it was happening in the banks, but now it's here. Now it's in front of us. It's going to be in front of us. And I think this is important for the European financial sector, but also for companies dealing with their own green transition in Europe. That's it. Thank you.
Indeed, I think 2 quick takeaways. First on the grids, which is fascinating and interesting to see that China confronts the same problem as Europe, as this need for huge investment in grids today. And the second one on the Chinese green finance and green bonds, and increasingly looking abroad for places to put this finance. And how do we think about economic security when it's not so much about trade or even FDI, but also green bonds, etc. Which brings us nicely to Joseph, who has a presentation on exactly this topic, looking into Chinese or other FDI and how you might think about that in the European context. I ask if you can try to stick to the 10 minutes. Thanks, Joseph.
Is it working? Yeah, it is. Okay, I don't know if you can switch to the presentation or... Yeah. Okay, wonderful. It's not a beautiful slide as yours. I mean... Anyway, so this is based on 2 papers, actually. One that analyzed the clean tech dependence coming from China, and basically comparing our own strategy with the strategy of Japan and Korea. I will not be able to dig that much into this one, but the second one is on the new joint venture strategy for clean tech, which was published in June, and kind of proposed with the help of 4 major law firms, a legal approach to enforcing joint venture with European majority And I think today it's a great day to speak about that, because if you have a subscription to Context, you probably know what I'm talking about. Okay, so next slides. If it's working. Okay, which one is this one? The gray one?
Let me see.
Wonderful. Okay. Before that, so I have 10 minutes, so we'll try to go fast. No, there is a slide before that. Anyway, yeah, that one. I think that most of the worried about China over capacity and its impact on the European market actually emerged after the COVID-19 pandemics. I think this is very, very clear. It highlights our super dependence, not only on medical device, but also on critical minerals. So I'm not going to speak that much about critical minerals, but just to be very clear, the dominance is massive because of a 25, 30 years piling industrial policy and strategy in all this. So if I want to go faster into this, I think this is better. So this figure shows that actually China is not a metal extraction superpower. Basically, it is a refining superpower. So in terms of their capacity to actually attract minerals from their own soil, but also from abroad, and to refine in China or increasingly outside of China, but using Chinese state-owned enterprise mostly. So the way China is basing its strategy is, okay, if you want to really summarize it to the end, you have like this mining in China or abroad that is mostly done by state-owned enterprise of the mining sector. State-owned enterprise doesn't mean necessarily central government enterprise. It can also be provincial or municipal enterprise or the mix of both. It's a very complex system. Then you do have the refining and processing, which is also mostly done by SOEs, and sometimes SOEs that are not in the mining business, but also in the chemicals and etc. business. Like for instance, an actor like Sinopec is also very involved into refining, because this is chemistry and it's a way to generate profit. And then only private companies arrived in the next part of the industrial architecture, which is the component manufacturing. Component manufacturing in many sectors, not only clean tech, but in clean tech, it's very true. Private firms work hand to hand with the second layers of a state-owned enterprise that I underlined, which are the ones that are refining the minerals in question. And then finally, in terms of assembly plant, which is in China or abroad, you have like mostly private firm. So this is the architecture in general. I'm going to focus a little bit very, very quickly on how it worked for the battery sector in practice. In practice, you had like this N curve, which is very well known to macroeconomists or a political economist, and it's really, really visible in the case of the battery sector in China, where the support given to companies rise very, 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 very quickly in the 2000s. Then you had the peak with a lot of companies able to manufacture different types of battery technology, mostly LFP, but not only. And then the government decided to stop most of these subsidies for a while, like around between 2010 and 2015, which ended up like to create a consolidation and merging between a lot of these companies, creating super big powers like CATL and BYD, and then after relaunched some support to the sector to actually create global dominance that we know today, which is especially in the LFP battery sector. Okay, so this is a picture of some parts of supply chains of different clean tech. So you have LFPs, wind powers, solar PV and electrolyzers. I think that one of the key element of understanding here is that actually half of this demand is coming from China itself. So it means that if you look at the red bar, it can be very impressive. It is very impressive, but half of the demand is coming from China. So the other half, you should just check the other half. And in the other half, China is also dominating most of the sectors, particularly anode and cathode in the lithium-ion batteries, which means that they are the one actually building what is high value and technical in the batteries. Perhaps without saying too much on this, one key part is the electrolysis sector, which we still have in Europe. Some good actors, or at least actors that are cutting edge. You see that actually China is quite glowing in that sector as well, especially in alkaline, but increasingly as well in all types of electrolyzers. The only sector where Chinese is still a little bit behind is actually on membrane. So the super cutting edge membrane that you need to actually create the anodes and the cathodes in very specific types of PEM, which are the ones that will probably at some points become the market makers. At the moment, we still have companies that are hedging on this. But if you look at all the other ones that are listed here, most of the higher end technologies are coming from China. Okay, so I'm not going to go too deep into the coercion because I think today it doesn't need to be explained that much. But you had many coercion, including the one in November 2025 on Japan, and there's what I call the mapping mandate here, which is basically ask Chinese companies to send information to their home base from who is using what of their output, so including critical minerals, but not only. So which means that if a wafer is manufactured in China, for instance, and sent into the European market, when this wafer is supposed you are supposed to say for what use the wafer is done, which creates a possibility for the Chinese government to have a mapping of our energy system. So this is the last publication on new joint venture. We asked this simple question, so what can we do? Because if you want to solve the equation of how to decarbonize and also how to go to economic security, or at least be a bit more sovereign in our energy sector, you need to have like a strategy for that. And we do believe that in some sectors it's actually not really relevant to stop using Chinese technology. So what should we do? Well, there is the possibility to use some sort of reverse Deng Xiaoping approach, so by using a European majority joint venture strategy. So how China used joint venture first, if you want to go for the history on this. Historically, they used it to condition market access with minority foreign ownership and tech transfer that were obligatory most of the time. It was a learning platform, most of the joint venture, for skills, process, skills, etc. And if you look at the empirical numbers, 80% of EU firms are in minority in JV in China. The state presence represents around 25% of the participation in these joint venture, and tech transfer were almost automatic for the last 25 years. And gradually in most of these sectors, these restrictions were relaxed when the Chinese technology were considered as similar to the Western ones. So when you hear some actors in the chemical sectors, for instance, investing massive amounts on their own in China, it's because mostly the Chinese believe that they are as good as them, so they don't need to have a joint venture with them. So the core logic is openness as a temporary tool and then not a permanent principle. So what can we learn? Because this is the situation we are in now. So in the clean tech sector only, if you look at joint venture in Europe, you have like mostly roughly 7 joint venture that are EU majority with Chinese companies. Then the Chinese majority of these joint venture are like 25. Then you have 50-50, which is around 3 of them. And then in the future investment that are currently being discussed, around 4 of them are supposed to be 50-50 as well. So significant majority for Chinese controlled companies. So many projects combine EU subsidies with Chinese technology and governance control, with limited localization in R&D, core component, and strategic decision making. And I will discuss a little bit later about the cost gap. One reason is also because the EU production is more expensive, so you have a lot of willingness to not like raise the cost for these technologies in the EU market. But the risk is that Europe internalizes cost and dependency, and China retains the learning and the scale. So this is like the numbers. If you really study it, each sectors in solar PV, well, it's depending on the tech and depending on the sector, on the companies, but it's the higher manufacturing cost is 20 to 50% if you have EU made modules, which is like in LCOE roughly 15% higher. If you use solar PV, when it comes to wind turbines, it's 30 to 40%. But the capex is actually for onshore. It's actually not that much when it comes to the final cost. And same for battery pack. You have like 20 to 30% higher cost. But keep in mind that this is also, we don't have the scale of China. I mean, like the scale of investment in gigafactory in the battery sector in China is massive. So if you do invest more in Europe, probably this cost gap will be reduced. In electrolyzer, it's actually not that much. It's between 0 and 20%. Heat pump, it's 1.7 to 2.5 times more expensive in Europe than in China. And carbon capture, that's a very difficult one. But for the numbers that we have, it's much cheaper in China, and this is explained because most of the examples that have been developed in China are in the chemical industry only, and so you have a high concentration of CO2, so it's easy to capture and to put them in the ground, to put the CO2 in the ground. So what we propose is a legal pivot to use the Industry Accelerator Act and other as central vehicle to allow conditioning market access, and that should be triggered by project side and strategic relevance. Because our problem at the moment is that we don't have a legal framework that would enable to do that. So what should we do? To amend the FDI screening regulation, to treat greenfield joint venture as reviewable strategic investment and allow authorization for conditional on JV structure, not just mitigation. This is legal words, but we can discuss that later if you want. And use the conditionality this conditionality in the Industry Accelerator Act and also for the Net Zero Industrial Act and the CRMA. And the justification, well, you can find a lot, but public interest ground, proportionality, and WTO if you use the Article 20. Or on security as well, you can argue with that. The core strategic requirement would be like 50% plus for EU majority ownership, and ultimate ownership and decisive influence should be the one discriminative factor, not only EU based, because then you can just have like a Chinese company opening a subsidiary in Europe and be considered as EU, which is not the case in this with this definition. And you should have also European veto rights on IP transfer, technology roadmap, and supply strategy. Qualifying majority voting for a strategic decision as well. And finally, yes, there is this localization obligation to mandate EU legalization for R&D and critical manufacturing step. This is very, very important when it comes to batteries, for instance, where you have like CAM, pre-CAM, and all the precursor of batteries that should be located in Europe if you really want to learn how to make this. At the moment, this is really unclear what the investment, for instance, in Spain by CATL will entail. Will it entail like only assembly, or will it entail also the CAM, pre-CAM? And then enforcement and incentive, you should have like EU funding and public procurement under the NZA threshold, only allowing access to these joint venture or European companies. Yeah, I think that's fine. And this is a conclusion, but I think I've spoken enough. Thank you.
Thanks, Joseph. Maybe one very quick clarification from my side on your proposal. FDI, pure FDI would be banned. Any FDI has to go through a JV. So, for example, the big Chinese battery plants or Korean ones that are built wouldn't be allowed, or how would that work?
So in our proposal, we consider public procurement, and the definition of public procurement for us goes like beyond only public procurement, but also anything that receives funding from public money. For €1 of public money should trigger this joint venture mandate. So if you are a private company, and you want to actually sell only to private actors without any public money, tax rebate or anything, that you can just enter the market.
So as a Chinese company, I could still build my battery plant, no strings attached. But if I want to access €1 of money, then I have to enter a joint venture.
Exactly.
Okay, thanks. I will pass to Barbara to talk broadly on economic security. Any thoughts you have? I mean, one thing that comes away from me is this shift away from just thinking about trade flows towards broader issues, towards FDI, towards finance. We have a president in America who still looks at things very much through trade, but increasingly in Brussels, I think it's obvious that economic security is not just about imports, not even just about exports, but it's a much broader context. If you want to talk on this, Barbara, or whatever kind of you've taken away from the first couple of presentation, the floor is yours. Should just work automatically, I think.
Yes. I will try to comment on both presentations. Very interesting, very useful. Thank you very much for them. Maybe starting with the first presentation. Also, because of the topic that we have today, I think when we look at clean energy deployment, the view on the EU and China is very convergent in a sense. We need clean energy for strategic autonomy. Just like China, we don't have fossil fuels, we cannot rely on them, and therefore for strategic economy and strategic autonomy, we need to have and we need to rely on clean energy. And that will be the view regardless of which political fraction you are looking at. Many people were worried with the newest, as the way you look at the European Parliament, whether there will be any changes to our strategy. But I think it's clear that clean energy, it's not only about climate, but it's also about our independence. And that will only be gaining relevance as it's absolutely clear we'll need more energy in the future. We're moving towards data centers, blockchain, it all uses tremendous amount of energy. And so the demand is only growing, and that means we will need more clean tech in Europe. And here I would just want to take 2 seconds to advertise how well we've done in Europe in that perspective. Today, 1/4 of our energy comes from clean renewable sources. And when we look at the electricity, that level goes to almost 50%. And this is great achievements. Just if you look 10 years ago, the levels much lower. The entire speed of energy transition was obviously accelerated by the Russian Russia trying to manipulate our markets. And in that respect, we have to also admit that the cheap supplies of clean tech from China very much help European Union to diversify and to increase our clean energy in a very critical moment in these geopolitical tensions. But when we took the strategy to diversify away from Russia and to increase clean tech deployment much faster, of course, it could not mean to us that we will increase our dependency on China. Because I think it was absolutely clear from the very beginning when President von der Leyen started with the European Green Deal that this is also a growth strategy for Europe. So the moment we see that the main beneficiary not being the European companies, but the benefits going to China, that means it's absolutely clear that needs to be rebalanced. And I think it was very useful from the presentations that we've seen here, that the competition on clean tech between European companies and Chinese companies, it's not pure peer-to-peer competition, but there is a specific market structure in China right now where we see massive support, we see subsidies, we see state push towards more and more capacities. And that led to the overproduction that we saw in the presentation today. So this is the struggle that our European companies need to face today. And this obviously prompts a reply for policymakers. One of the first replies we had was the Net Zero Industrial Act, which looked into easing regulatory barriers, into supporting investments via, for example, European Hydrogen Bank. We put emphasis on the resilience criteria and the public procurement. Public procurement is responsible for a lot of demand in Europe for clean tech. And also stimulating innovation. We created a concept of sandboxes where in a regulatory framework you could test new and innovative ideas. But I think it's clear to everyone, Net Zero Industrial Act is not the end of the story. It's actually quite the opposite. It's the beginning of our industrial policy. But as the situation developed and as we try to help our companies, let's say, thrive in the new environment, it's also clear that we need to look at the entire value chain. And this is what we've seen in the second presentation. A key component of every industrial strategy are critical raw minerals. The dependency that EU right now has on China and on the minerals, on processing, are absolutely not acceptable. And that also we saw are subject to weaponization in October restrictions last year, which was also a big wake-up call for the EU. Our strategy on diversification of critical raw minerals, of course, started earlier with the Critical Raw Minerals Act. But what happened in October meant that we needed to accelerate whatever the policy and the plan was. So last year in December, the Commission adopted Resource EU action plan, which is a clear strategy on how we can advance our deployment of various actions to support clean tech via the supply of critical raw minerals. This is a very straightforward strategy. We identified that we want to focus on battery, rare earths, and defense. We promised to activate 3 billion euros for 60 strategic projects located both in the EU and in partner countries. And these are the projects that can deliver by 2029. And those projects are now the focus of our attention and the financial support. When I talk about 3 billion, this is the money that, let's say, Commission can promise, but on the top of that, we have funds managed by member states. These include cohesion funds, that includes just transition funds, and we are working very closely with member states to ensure that all this funding is going towards critical raw minerals, because without it, we won't be able to help our industry. And of course, the strategy is not only mining and processing, but also recycling. Here we also announced certain trade restrictions to ensure that our companies who want to engage into circularity will be able to do so and will have the necessary material. And on the top, we also announced the creation of the Critical Raw Minerals Center. Every strategy, of course, requires comprehensive and global approach, and we feel that this center also taking great lessons of the road to independence that Japan has done. It's key part of our component. And of course, this is the part of the value chain, and moving forward, we see that those critical raw minerals will not be helpful if we see any other dependencies going up the chain. So together with this, there is a comprehensive overview of where we still see our dependencies. We promise to look proactively, not wait for the crisis, but see how we can help, where are the choke points, and where the companies need support. And that is quite a lot of focus of the unit where I work as well, of economic security. And finally, moving to clean tech industry. As I said, net zero was just the beginning. Now the focus is on the Industrial Accelerator Act. The act was promised for December. Now it's going to be end of January. The discussions is still ongoing on what is the best approach. I think from my side, I maybe only would like to focus on two things that are very important for policymakers and which are a big part of our consideration. When it comes to subsidies, it's very difficult to compete with the level of subsidies that we see in China. Therefore, there is more and more political support towards local content. And in that respect, public procurement or any sorts of subsidies that are given by member states is certainly one angle to look at it. And a second, of course, is foreign direct investments. We have the screening regulation, and that's one element, but another element is to ensure that there is an added value in the EU chain. We have a big market, we have a lot of interest from companies, and of course, if there would be a consideration for local content, that can attract more investments into the EU. But that means also we should use that strategically for the advantage of European companies. So these are the considerations from our side, but I'm happy to take questions and answer any additional thoughts you might have on this topic. Thank you.
Thanks, Barbara. But as the chair, I get to ask the first question, and then I will be opening the floor to everybody here. In my haste to ask Joseph the clarification, I should have emphasized what he said at the beginning, and Barbara, which is that there is a leak of the Industrial Accelerator Act, and Joseph could have been in the room drafting it, because I think much of what he said is there. So that's kind of the context for this discussion. I mean, it's not public yet; it hasn't been officially proposed by the Commission, but it looks like words to the extent of what Joseph proposed on FDI will be proposed by the European Commission, which is a pretty significant proposal. I would build on this and ask a question, and then turn to the audience, and I structure it in two parts. The first on the trade-offs here, and Joseph discussed the trade-off between a short-term slowdown in climate goals and long-term industrial resilience. Perhaps the climate goals we increasingly seem not so concerned and we forget, but there's also a short-term trade-off with economic resilience and economic security in the short run, which is that for every solar panel or wind turbine or EV or battery that we don't install, or it costs 10% more, we import more oil and gas. And historically, we've never seen really serious economic security from clean tech, but history is full of economic security from oil and gas. And I think this sometimes is missing in the debate, this idea that we sacrifice today for long-term economic security, but we will increase in the short run our dependence on oil and gas. That would be the first part. And then second part would be, if we come with these much more stringent FDI regulations and we require foreign companies to do this, what's our assumption? Is our assumption that foreign companies will just play ball and they'll go along with this and come in? Or is our assumption that European companies will now step up and deliver what they haven't delivered in battery or supply chains over the last 20 years? Which one of those is it? I would give to Joseph first, because he proposes it and he agrees, and then I would ask Alicia and Barbara if you broadly agree with the proposal, and if so, what you think of these couple of questions. You, Joseph.
Yeah. Perhaps for the last part of your question, I think, are we going to attract these investments if we put this strategy in place? Well, of course, it depends who you are speaking to. If you speak with super big clean tech giants like BYD, for instance, anyway, they need to have access to the EU market. They would be very happy, probably, to have like plants here to develop their supply chain. That's basically private money for them. That's their own money. It's an investment. If you discuss with the Chinese government, that's another story. And you had like some opinions from some major Chinese decision makers saying that if a government is implementing measures like that, then you should not invest. Saying that to the private sector. So what is going to be the deciding element here? I still think that the necessity for the macroeconomic necessity of the Chinese companies to find market outside of China, and especially high-end markets, will be decisive. And at the moment, I mean, it may not be the case for much longer, but for the next decade or so, the only really accessible high-end market in the world that is still open to Chinese companies is Europe. You will have probably interest from Southeast Asia that is, with growing and growing demand for high-end product, but at the moment this is the only market that they have to really make big margin. And I'm speaking about automotive industry, but not only. It may be a bit different for the PV sector, and I think Alicia explained it very well before. I mean, like the margin in the PV sector are razor slim. So they have a problem of model there. But it's not the case for other clean tech.
Just a quick note on whether they will come. That's a question, given this additional conditions. We need to realize that when you say private companies want to come, it's based on the fact that we may close the market, because their margins are higher in China. They prefer to export. Let's not forget that. This is the second best, not the first best. Nobody wants to produce in Europe if they can export from China. Not even the private companies. So if we open the market again, but by the way, we've not closed the market. It's obvious. You already showed that basically the price differential is such that our tariffs are not, if that was the objective, they were too low. If that's what we found in terms of subsidies, they were right. But I'm saying it depends on the objective, yeah? So if we are going to go into minimum price undertaking and and they see that there's not going to be any more tariffs, I can tell you, the word in Shanghai today is Kai is back, just because of the minimum price undertaking, which is a guideline, and we don't even know, whether companies will comply with the criteria, yeah? Point is, the more open the market is, the less interest there will be, beyond the government's considerations. So that's a trade-off we need to realize. It's not only about imposing conditions, because that assumes they want to come. But we're not sure they want to come, especially if the market is open. That's it.
If I characterize then this view, it's that we need the closed market for clean tech from China in terms of trade flows, and then there may be a willingness on their part to come under these conditions and give away a lot of IP, so it's not certain that they will come. Of course, the worry then is that they don't come, and then we've closed the market to the Chinese products. The Chinese don't come, and then the European, American, other companies have to try and do this, which is not. I mean, you had your slide showing all the different price percentages. It's a pretty significant impact. Barbara, any thoughts on this before I will open the floor to any questions from the audience?
Sure. I think just want to make one point. I think there's bigger realization in Europe of the attractiveness of the EU market in terms of the demand we create. It's what you said. If you look at the demand into clean tech until 2030, I mean, Europe is the place to go. Despite what we see of the Asia's growth, of the other places' growth, Europe is the only market, for example, where we have CO2 standards for cars. Nobody else offers the certainty in terms of sales and how much you can increase your sales into Europe. We have one of the biggest and richest markets. And of course, this is something that there's more and more question of how we can use. So we're not only flooded, but we also can use to the benefit of the companies and to ensure that the size and attractiveness of this market is benefiting the companies in Europe. And I think, without going too much in discussion on Industry Accelerator Act, which I cannot do, I just want to underline that this is, the more and more thinking how we can use the what we have in a more effective manner to also support our industry and to make sure that they benefit from it is more visible in Brussels.
Thanks. Already one question I see from the gentleman there.
Oh, thank you. Sorry. I think you meant the person behind me, but
we can take two and then pass back to the. So
okay, thank you very much. Nicholas White from APCO, but speaking purely in a personal capacity. I want to thank you all for a very interesting presentation. I thought that the sheer scale of the numbers at the beginning was awfully impressive, and I think that Joseph's proposal is a very good one. And I work with some Chinese companies, and I work with other companies that are trying to get into China. And the issue that has unexpectedly become a problem is predictability. particularly with the tariffs last year, the EU is losing its attraction as a place of predictability for Chinese business. This isn't entirely fair because China's not been awfully predictable either, and as for the United States, well, I don't need to finish that sentence, but I think that Joseph's proposal, and I understand that this is what's coming from the institutions as well, I think we should remember that although Europe has got all these many economic by the numbers aspects of attraction, I think predictability is one of the really important things that we have that others sometimes don't. Thanks.
Rory McRae from Fortescue, an Australian energy and metals company. Thanks very much for the presentation. Very interesting, forward-looking. I have a question on the kind of the outside and the external side. This is very much focused on investment in Europe. What are the dangers of making Fortress Europe, delaying competitivity, and what does this mean for third country markets in clean tech? I mean, okay, maybe the action is here for carbon. Look what's happening in Brazil for EVs already, and PVs elsewhere. It happens with price when the price goes down. So how do we integrate the third market aspect into our own competitiveness?
And just to remind the online audience, EU China Green, in case they're interested to pass on to Slido. On predictability, CO2 standards you mentioned, which I would argue aren't that predictable anymore. I'm not sure if you'd like to take this one, Barbara, and then third markets may pass over here.
I would argue that it's still quite predictable, picking up on the CO2, because even if you slightly change the approach, the direction is still there. And it still show you the magnitude of the demand that we are envisaging. In terms of demand, we also have the Renewable Energy Directive. We have the sense of travel. Even if there are small changes here and there, as I said, it's a matter of strategic autonomy. It's a matter for us of being able to maintain our energy, create our energy independence. So the sense of direction is there. As I said, it's climate plays a big role, but there are other aspects that reinforces that predictability. On Fortress Europe, I think it's a good question. Of course, Australia is a very important partner for Europe, and that is something certainly that plays a key role. How do we protect ourselves from the oversupplies that are coming from China without creating that Fortress Europe image? Because as you see, Europe is now driving towards more free trade agreements. There is a big push to increase our partnerships, and that is certainly something that we will continue to respect whatever design we're going to make. And so I would expect, but speaking in private capacity now, it's that the measures will need to be targeted to ensure that those with which we have good and open trade will maintain that, because certainly there's not an idea that we will do it alone. Absolutely not. We want to build those partnerships, and we are open to any kind of partnerships as long as this partnership is balanced and benefits both ways. And I think that's very key consideration that you will see in the Commission's proposals.
Would you like to pick up on either of them, or no? Joseph? Or?
Yeah, perhaps just a little bit on third market. It is true that if you raise the cost of, let's say, a battery made in Europe, then you will perhaps lose interest from markets that are seeking cheaper version. But anyway, it's happening anyway. So I don't think we have a choice here. I mean, it's not either or. It's a question of, are you going to sell a Volkswagen with a Chinese-made battery for the next 10 years in Brazil, or are you going to try to sell a Volkswagen with a EU-made battery in Brazil?
But the question would be if the Volkswagen with the Chinese-made battery is more competitive and hence gives us this, which I think is what's happened in Europe, is that we've welcomed FDI into batteries. Mm-hmm. I think about 4/5 of battery capacity in Europe is foreign. But for EVs, Europe, still in the European market, there are Chinese EVs coming in, but not so many. And Europe is doing well in EVs because it has this FDI into batteries. So there is a trade-off there now.
Sorry, I think the question might be slightly more difficult. we are the market, but Volkswagen can produce in China for our market. Full, not only the battery. That's called China for the world, which is the opposite of de-risking, the way I read it. And that's where we are now, because it's cheaper there. So, and then in a way, it's cheaper to produce, it's, you know, it's integrated, so that's the question. It's not only third markets, it's our market, yeah? But it's our market with our companies. And in a way, I get it, why not? I mean, the question is, what's the problem with this? The problem is the industrialization, innovation elsewhere. I mean, there is a problem, but from the company's perspective, there's no problem. So this is, I think, what we need to think, yeah? It's not only about Chinese companies being imposed all of these criteria. I'm really thinking our companies. Yeah, our companies. So, you know, I'm saying that the concept of JV applies to Chinese companies coming over. But I don't know whether we have any other, but this could be outbound investment screening, we could think about other ways, but that's not the only issue. But I just want to tell Haoxin that if, Haoxin, anytime you want to jump in, please tell us, because, yes.
I give him the extra 5 seconds for the delay, but I think he's good. I look back to the audience in case of further questions. Otherwise, I would enjoy pushing back further myself, which it looks like. I mean, again, on this, you know, batteries to EVs, there's then the question of how far back along the value chains do you go? Is it that we now want the JVs for making batteries in Europe? Okay. The anodes, the cathodes, okay. The lithium refining, the lithium mines, do we want them in Europe? Not really. I mean, try and build one of those in Europe. You see the protest. Do we want to be owning cobalt mines or nickel mines abroad? And you know, but this is an obvious question. It's very hard to do this, but I think there's also the related question of who defines these. So not just what are the strategic sectors that you define, but also who defines them. We saw with the Net Zero Industry Act the idea of defining some key clean tech sectors which are important, and we ended up with, I'm not sure exactly, I think 19 or so in there. I would argue that not all of them are strategic. So you do create this risk where this kind of balloons into an all-encompassing thing across the economy, and I mean, there's just trade-offs all along the value chain. How do you intervene? So not just solving the trade-offs, but also the role of policymakers, and I suppose the European Commission in either having their hands tied by some very strict and stringent objective requirements, which we would like for transparency, and we would like to avoid lobbying, etc., or having some political impetus and political possibility to do these things, because the world's not that simple. You can't divide it up and just assign these criteria. I don't know if you have thoughts on my...
I actually want to pick up on something specific that you said in developing the thoughts. Do we want mining in Europe? I think it's a very important question because there's certain perception associated maybe with coal industry that mining is bad. But when we look at strategic autonomy and our idea of how to, let's say, ensure that our companies are not dependent on others, and you look at the resource EU communication, we are now supporting mining in Europe. And I think it's very important because for potential investors' perspective, mining in itself is not bad. And mining in Europe very often means that it's more sustainable, then it's done in a better way. Some of them are done with innovative technologies that, for example, reduce the chemicals or CO2 that is produced along the way. So in that perspective, there is a support for mining of critical raw minerals in Europe. As much there is support for processing and for recycling. So I think that concept is something that we need to, and it's important to clarify. And in terms of the sectors to choose from, yes, we need to be strategic, and that's why when I mentioned Resource EU, we focus on batteries, rare earths, and defense. On net zero, yes, there was quite a long list, but I think what we see that we want to support our industry for whatever we think it's important and strategic. So trying to be narrow or too narrow could backfire for us. So this is a discussion that is still ongoing for Industrial Accelerator Act, but it's important question from that perspective, because the trade surplus that we observe from China is only growing. It reached 1 trillion euros, 1.2 if you look in dollars. It grew 20% in just last year, and in December alone, the trade surplus was 100 billion euros. And so you see that this is a big threat for our industry. And so, narrowing the support too much, and it means that we can lose quite a lot. And as we saw from the presentations, this is also based on specific situation that it's in China, and with which our companies are struggling to compete. So support is important, and as I said, we cannot be too narrow in either, because there is a lot of at stake for our industry. Thank you.
Yeah, I mean, if you look at how China is doing it, I mean, it's a little bit like everything everywhere all at once. I mean, like they have invested in almost every types of critical tech or critical minerals and refining capacity that you can ever think about. Of course, I do not think that Europe should do the same. I think we are not at the same stage of our economic development, etc. We can afford to be reliant on the global market when there is a global market, and when this global market is not distorted. The problem is that for some of these technologies at the moment, the dominant actor is able to avoid competition because of all the architecture we discussed before. I mean, Alicia mentioned the tariff supposedly to compensate subsidies. This is very true. The tariff was supposed to compensate the proven subsidies in the EV market, but the problem is that what about like the benefit of this structure that we do not have? I mean, the fact that most SOEs in the mining and refinery sector, they don't need to make high margin, in itself is a subsidy. It is something that you cannot really calculate easily, but it's in itself a subsidy. So you cannot ever compete with that. So you will have to create conditions for some actors that are outpriced by this system to still be on the market in order to be secure. And the only way to do that is through local content. It's the only way. Or you put like huge tariff like Trump style and you invade Greenland. I'm sorry, but this is the reality. I mean, like, if you still want to be a rational actor here, you have to act in a way where you enforce gradually local content in your requirement, and then you can decide that, okay, if this is coming from Australia or this one from Chile, it's fine. Because it's not one single market actor controlling everything. It's not necessarily made in EU. It can be made with EU, for instance, for some of these technologies or for some of these minerals. If you look at lithium, for instance, I do not believe that we will have one day 100% of our lithium made in Europe. This is not going to happen. Same for cobalt, but at least you can use this instrument in order not to have one single actor providing everything.
Thanks, Joseph. If there's no other questions from the audience, I would pass to Alicia either to comment on what you've heard in the last couple of minutes, or maybe to give a couple of thoughts on the tariffs themselves. We kind of stopped talking about trade and we moved to investment and FDI, but with Daniel, I just read your piece this morning, it's not public yet, but the proposal from the European Commission to shift away from a tariff on the import of Chinese EVs towards a minimum price undertaking, if you might share some thoughts on your perspective on that.
I think before I do that, I just want to make for everybody to realize that one of the reasons we're here, and I think Haoxin showed it very clearly, is that while China is still going ahead with its transition, massively, that market is not open. So in other words, we can talk about whether we should close ours or not, but I think the conversation could be very different if maybe it's too late for some. We're not You saw the list. We're not competitive on any, according to your. But then are we in a world where China is competitive on everything and we're not competitive on anything? Because if that's the world, let's accept it. But is that true? Is that true from the beginning? Will it always be true? I think that's a very fair point to start with, because maybe a frank conversation with China on a real, I don't know, joint Green Deal, let's, keep on decarbonizing the world under other circumstances, meaning for us to play fair, both markets have to be open. And yes, maybe we're late on most things, but maybe not on all things, So I think we might need to switch from, okay, how do we protect ourselves to opening that market? I know we've tried for a long time, but at some point, I think for China also this might be eventually on green a possibility, because that's the one and only area, sorry to say, where we're going to collaborate as we stand. So we should give it a chance. We should say, okay, let's talk frankly about this. And I think the reason why I really think Haoxin's calculations on funding is important, because before China could do this on its own right, meaning it could finance this out of the profits made with the rest of the world, no more. And that's an opportunity. The fact that China needs external funding is an opportunity, because finally China needs something. That's it. They need funding because they're not being profitable on this. So I think it is important to look at that angle before we even, which I will in a minute, but I wanted to highlight that I think Haoxin's calculations on the financial needs are not just because they will develop green finance. No, it's more important. Finally, to do that green transition, China needs funding. Maybe its own funding, but they need to take it away from something else. So, this is a strong point to think out of the box, not just, okay, protect. So that's what I wanted to say, just to highlight Haoxin's work on this. He's made many calculations, so he deserves it. Secondly, on this price undertaking, very quickly. I would say that I now understand a little bit more where this is coming from, and I get it. We want guidelines, maybe not for every company, blah, 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 fine. But I'm going to say this loud and clear. These tariffs have been there for, 14 months? Doesn't sound very credible that the European Commission fights for that. Supposedly, we need it, yeah? All of these subsidies took us forever to calculate. And suddenly, what happened? I think this is a signal of policy uncertainty. Going back to the point that we suddenly, move away from tariffs to guidelines on minimum price undertaking. But also because I don't see very clearly how that, going back to my point, is going to help attract investment. Because if I am a Chinese company, I prefer minimum price undertaking. Mm-hmm. It's more money for me. I don't need to, jump on a market that might change, maybe with local content, with everything you said. Oh my God, why would I come? So, I think changing this all of a sudden may give that signal that no need to come, rather than let's come, let's get into this market. That's why I think it's a very, it may have other reasons. I understand there's other reasons for this, but not everybody knows why this was done, yeah? And what matters is what people think, sometimes not even what, the underlying reason, but what people see. What about our negotiations with the Indians? What are they going to think? So for me, this is the problem with switching these policies. Unless you have a very strong reason, can be one company, or it can be, it can be a small thing. It has to be a very big thing for me to change a policy that has taken me so much effort and political capital to reach. And this is not because I think these tariffs are right or wrong. It's mostly about, okay, it's done, yeah? It's done. Have those subsidies disappeared? Has China retaliation disappeared on dairy or not yet? So, it's the image, and given what's happening with the US, is not like on a strong position, yeah? Let's put it this way. It may be, but it doesn't look like, and that's not good when you are negotiating with big economies like India. So in that regard, I hope I will know more, but I have a very mixed feeling, to say the least, on this minimum price undertaking, since you ask.
Thanks, Alicia. I think that's about all we have time for. It's been very engaging and interesting to hear the debate and the discussion. The quite fun thing is that we are now going to see it probably happen in practice, so we can come back in a year or 2 years maybe and discuss. We're going to see, I think, the Commission on Friday propose, I don't know if you would call it the creation of the EU Fortress or Fortress EU, but in this direction. And then I guess we'll see 2 tests. We'll see first the political test. Does the Parliament and the Council agree? Probably they are going to. The Chinese, I'm sure, will be on the phone, and the Americans putting pressure here. And so we'll see how first the political test goes. And then we'll get to see the economic test. What happens when the EU does try to create Fortress EU? Are there simply leaks in the side, like with the tariffs? It also didn't mention, but the plug-in hybrids. I mean, just the tariffs were on only pure battery cars, and all of a sudden you saw a lot of surge in plug-in hybrids from China. So are we going to see leaks in the Fortress EU, or are we going to see the creation of Fortress EU, and then we'll see what that entails? Do EU companies step in? How much do we slow the process? So, I mean, at least from an academic perspective, that's fascinating that we'll get to see the results of this. So thank you all for joining us today, and enjoy the rest of your afternoon. Thanks.